Hello, Barry. How you doing?
Hi, I'm doing good. How about you?
Good. Good to have you aboard here.
Appreciate you.
Hi, Maria.
Hi.
We got a crowd today. Monday, nobody showed up. How come?
I went on Monday and it didn't start. And I stayed on till like 1:15 and it didn't start.
Yeah, I joined kind of late though, so it's probably too late. I joined at like 1:10 and nobody was in that joint.
I'm a little stunned because you probably saw I did the lecture at 1 o'clock. The only possible explanation, and I'm going to blame me, is maybe I hit the tutoring link by mistake.
Yeah, because when I joined it said it was waiting for the host to start it.
Yeah. Oh, sorry about that. I have to investigate this. Hi, Brendan. We're ready to get started, okay?
Sweet.
Okay, hold on 1 second here. Come on. Can somebody verbally tell me they see the slides?
Yep.
Okay, thank you. That's another mistake I make about once a year. I forget to put the slides up and I end up babbling to a confused audience, okay? But here we go. Accounting for merchandising operations. We just went through a pretty intense first 3 chapters. And now we're going to get into a little bit of a more not detailed, but a more specific area of the world. We're going to talk about a merchandising operation, meaning a store, meaning somebody who buys and sells something, as opposed to providing a service or manufacturing something. Okay. Wow, look at all these learning objectives, huh? Conceptual, analytical. Let's just divide and conquer. Learning objective. Describe merchandising activities and identify income components for merchandising, okay? Revenue. Service, for a service they're starting with a service company. They sell time to earn revenue. A service company just delivers something, a law firm, a plumber, somebody like that. Reporting income for a merchandiser, though. Merchandise company sells products to earn revenue, sporting goods, clothing, auto, whatever you can think of, okay? And then we got a reporting income statement here. We're going to show the net sales. The net sales, those are defined as gross sales minus sales returns and allowances and sales discounts and maybe credit card charges. Net sales minus cost of goods sold equals something called gross profit. And understand that cost of goods sold is an expense. It is simply what we paid for the merchandise we sold. So if we bought a garment for $400 and we sold it for $1,000, the net sale would be $1,000 and the cost of goods sold would be $400. So the gross profit is how much money we're making just on the buying and selling. And then we have to subtract the normal operating expenses of a company, the salaries of the employees, commissions to salespeople, perhaps insurance, whatever you can think of, to come down to net income. And make this a little bigger here. And there we see the income statement on the right. Net sales minus cost of goods sold equals gross profit minus expenses equals net income. And that is a template you're going to have to know like the back of your hand as we go forward. Identify and explain the inventory asset and cost flows of a merchandiser, huh? Well, it begins with the purchase of the merchandise. It ends with the collection of cash, huh? So here we go. They're saying we purchased these bicycles. we sold them, and we received payment from the customer. The normal, basic, simple business cycle. Inventory system. This, I hope we get into some detail in the next chapter. They don't really do it here. You have a beginning inventory from last month. It would be the ending inventory from last month, plus whatever you purchased this month. That's going to give you a number that we're going to call the material available for sale. We had 10,000 garments at the beginning of the month. We purchased another 20,000 garments. That gives us 30,000 garments available for sale. 10 at the beginning plus the 20 in purchases equals available for sale. So that 30,000 available for sale, those 30,000 garments can only be in one of two places at the end of the month. We either sold them, which means that that cost is now moved to your cost of goods sold, and you're going to show up that way on the income statement, or we still have the garment, we haven't sold it yet, and it's in ending inventory. So that merchandise available for number is a crucial component, because that's from that you're going to spread the ending inventory and cost of goods sold. Two kinds of inventory systems, huh? Periodic system. We did a lot of this in Accounting 110, mainly to get you used to the idea of how the inventory costs flow. Periodic system, we don't record the cost of goods sold till the end of the month. We sell something, and all we do is debit cash, perhaps, and credit sales. We don't do anything with the cost of goods sold. Thus, at the end of the year, under a periodic system, we have to take a physical count of what's out there and then realize what we sold at cost. Perpetual system, which is what we're going to be working on here, is what the whole world kind of uses now, I would think. It updates the accounting records for each purchase and sale. In other words, under a perpetual system, meaning forever, under a perpetual system, you always know how much inventory you have of any part at any time, and you know what your cost of goods sold is as of that particular date. Under a perpetual inventory system, you're going to record the sale, just like the periodic system, but you're also going to debit cost of goods sold and credit merchandise inventory for the cost. So each sale is a 4-line journal entry under the perpetual system. Analyze and record transactions for merchandise purchases using a perpetual system. Okay, purchase without a cash discount, huh? Purchase $500 for cash. Well, that couldn't be much easier, huh? We debit merchandise inventory and credit cash. Purchase goods for cash would be our simple explanation. Now, Z-Mart purchased $500 of merchandise on account with credit terms of 210 net 30. To those of you who've not seen 210 net 30, it means you get a 2% discount if you pay the bill within 10 days. Otherwise, you pay the net in 30 days. 2%, 10, net 30 is how you read that. 2% discount. If you pay in 10 days, you pay the net, otherwise in 30. Okay. And you can have a whole bunch of these, 1%, 10, net 50 or something. Purchase discount. And here's what I was just talking about. 2% discount, payable in 10 days, paid in 10 days. Otherwise, you pay the net in 30 days or 50 days, whatever it might be. The credit terms, a deduction from the invoice price granted to induce early payment of the amount due. That's why companies offer a 2% discount to accelerate their cash payment. They're willing to give up 2% of their sales to get 98% right now. Okay. And by the way, a 2%, 2% 10 net 30 discount is nothing to turn down. Annually, that means you're earning 37%. If you think about it, you're earning 2% for giving up your money for 20 days, right? 30 days or 10 days. You give the money up for 20 days and you earn 10%. There are 365 days in a year. You divide 20 into that, and that means you're earning 2% 18 times a year, or about 37%. So it can be a significant item. Here's an invoice. We know what invoices looks like. You have the seller and the invoice. I'll just blow this up a little bit if you like to look at it for a second. But it's got the sold to, and it's got the terms here. 210 net 30. There's a purchase order date, the salesperson, all kinds of information. The shipping terms, in this case, FOB destination via FedEx. And that is a nice, clean looking invoice. Well, Z-Mart paid the bill on the purchase of November 2nd. They didn't take a discount. I'm sorry, they did. They did take the discount. My eyes are shut. They did take the discount. So 2% of $500 is $10. So they owed $500, right? And now they debit that for $500, accounts payable. They credit merchandise inventory for $10, and you credit cash for $490, okay? So after we post these, this is what our general ledger is going to look like. We had accounts payable that we had to pay $500, and we got rid of the whole $500 in debt, but it only cost us $490 in cash. The $10 goes into an account called merchandise inventory. If it was a periodic system, we would call it purchase discounts. Z-Mart paid the amount, but they didn't pay it within 10 days. So the question is, are they entitled to the discount? The answer is no. And where I worked for many years, we had longtime business partners, suppliers, bought a lot of stuff from us. And once in a while, they would not take the discount. We would get the check maybe 20 days instead of 10. And the question we always had was, do we go after these guys for the discount amount, or do you just let it go? And really, for the most part, you pretty much might ignore it for fear of angering a longtime good customer. I mean, a guy's been buying stuff from you for years, and then one time he doesn't pay you on time. I think he's still entitled to the discount. Purchase returns and allowances. Purchase returns allowances. Purchase returns is just that. Merchandise is returned by the purchaser to the supplier. We've all returned things to a store because it was the wrong size or the wrong item, and hopefully we get credit from the store. Purchase allowance is a price reduction to the buyer of defective or unacceptable merchandise. For example, you bought a toaster and you just don't like the way it's making your toast. There's something you don't like about this toaster. So you take it back to the store and you say, I like a credit of $50, which I paid for this toaster. And the merchant might say, how about I take $10 off the price and you keep it? That would be a purchase allowance. You keep the toaster and get that break. Purchase allowances. Here we go. Z-Mart issued a $30 debit memo for an allowance for defective merchandise. Z-Mart was contacted by Trex, I guess, and Trex said, we want to return this, say, $100 item. And Z-Mart said, why don't we do this? I'll give you $30 reduction in the price if you keep it. And they said, good enough. So there's your entry. Debit, accounts payable, credit, merchandise inventory. Purchase returns. This is a little simpler, I guess. You're just returning something. Z-Mart purchases $250 of merchandise on June 1st with terms 210 net 60. Okay. There is your first journal entry, a debit to merchandise inventory and a credit to accounts payable. Not too bad. On June 3rd, they returned $50 of this stuff before paying the invoice. And they received a debit memo or credit memo. So they were entitled to reduce their accounts payable by 50 and credit merchandise inventory by 50. Return goods to seller. When Z-Mart pays on the 11th, it takes the 2% discount only, of course, on the $200 remaining. So they wipe out for $200 worth of accounts payable. They get this return discount amount here, $4, 2% of 200, 2 times 2 is 4, and the cash, $196. Purchases and transportation costs. Shipping terms, huh? Shipping point, FOB, shipping point, FOB, destination, freight on board. That's what that means, freight on board. FOB is the point in time where title changes hands from the seller to the buyer. The FOB point is the point in time where title changes, okay? It has significant importance regarding who pays for what or who's responsible. FOB shipping point means that the title does not pass, that the title passes as soon as the item is shipped. So you ship a truckload to me at my place in Newark, New Jersey. And if the deal is FOB shipping point, I, in New Jersey, own that truck as it travels across the country. If that truck has an accident and the merchandise is damaged, it's my insurance that's going to take care of it. I'm responsible for paying the freight. Or you could have FOB destination, where the where the seller owns it until it arrives at the destination. That way, the buyer doesn't have to worry about anything. It's the seller that's responsible. So the transportation charge, FOB shipping point, we're going to call it debit merchandise inventory, credit cash. If it's destination, though, it's considered a delivery expense on the shipper's part, and credit cash. So I like you to get familiar with the FOBs. You could have FOB Chicago, FOB Mississippi River, or something like that, just when title changes. Purchase merchandise, FOB shipping point, huh? Transportation charge is $75. That's because the buyer is responsible, because the buyer bought this material on shipping point, on FOB shipping point terms, and title changed to the buyer as soon as that truck left the California location, okay? And we're looking at costs of purchases here. And when you do your longer income statement, which we'll get to in a chapter or so, you're going to start off with the invoice cost of the purchases. Okay. We bought something for $235,800. We took a purchase discount of $4,200, and we took a return and allowance of $1,500, but we had to pay the freight. So the net purchases come to $232,400. Net purchases. That's where you take the beginning inventory, you add the net purchases, and you're going to come up with that number we called merchandise available for sale. And the merchandise available for sale can only be sold at month end or not sold. If it's not sold, that cost goes into the inventory. If it is sold, that cost flows out through the cost of goods sold. Perpetual system, couple of transactions, huh? Let's see what we have here. Accounting for merchandise sales. Net sales. What are net sales again? Gross sales minus sales discounts, sales returns and allowances, and credit card fees, huh? Net sales minus cost of goods sold gives you something we call gross profit. It just means how much we're making on the markup of the product. Sale of merchandise. Each sale transaction for a seller of merchandise involves two parts. You have to record the sale, the revenue, which you do in both a periodic and a perpetual system. But unlike the periodic, under the perpetual system, you recognize the cost of goods sold with the transaction. So you could have a 4-line journal entry or a pair of 2-line journal entries. Let's see if they demonstrate it for us. Z-Mart sold $1,000 of merchandise on credit. Merchandise has a cost basis of $300. In other words, Z-Mart bought a garment for $300, which they sold for $1,000. So now we sell it. We record the sale with a debit to accounts receivable and a credit sales. The cost of goods sold side, we debit cost of goods sold and credit merchandise inventory. So the profit on the sale, the gross profit, was $700. And we're back on the sales discounts again. Sales discounts can benefit a seller by decreasing the delay in receiving cash and receiving future collection efforts, okay? I don't particularly like this arrow, what they're trying to tell us here. The amount due minus the discount, otherwise it's due out here. Discount refers to a purchase discount for a buyer and a sales discount for the seller. So one man's cash discount is another man's purchase discount. Z-Mart completes a $1,000 credit sale with terms of 210 net 45, okay? Well, we sold the goods, debit accounts receivable, we credit sales, huh? Debit accounts receivable, credit sales, but we also have to recognize the $300 of cost that we paid for that garment. So there's our debit, the cost of goods sold, and a credit to manufacturing, to merchandise inventory. Now the buyer pays us within the discount period. So the buyer clears up $1,000 worth of accounts payable to him, accounts receivable to us, with only $980 because he got a 2% or $20 discount. If he pays after the discount, he does not take the discount. He has to pay the full amount. Sales returns and allowances, huh? Usually involve dissatisfied customers and the possibility of lost future sales. Sales returns refer to merchandise that customer returned to the seller after a sale. Sales allowances are reductions in the selling price of the merchandise sold. It says sales returns and allowances usually involve dissatisfied customers. I guess that's right. But I mean, a lot of times you return something because it's just the wrong size or a wrong color or something like that. Not necessarily dissatisfied, but companies want to keep track of this kind of information. They want to know how much of their stuff is coming back. Sales with returns and allowances, okay? Sales with returns and allowances. We have goods returned here. Goods costing $9, which were sold for $15, were returned to us. We're the seller now, huh? So the sale has to be reduced by $15. And I can't believe I haven't said this yet. You never debit sales. You never debit sales, never. You always debit the contra account, which in this case is sales returns and allowances. Okay, so we debit sales returns and allowances and we credit cash. Return the goods, not defective. Return goods, here, we debit merchandise inventory and credit cost of goods sold. The inventory came back to us in good shape, is what they're assuming here. So we're allowed to put that $9 back on the balance sheet with a debit to the inventory and a credit the cost of goods sold. And now here, if they are defective, we got the goods back. And even though the original cost of the garment was $9, it came back slightly damaged. So we can sell it maybe for, $3 or something. And the cost is only going to be $2. So we're saying that the garment that came back is only worth $2 now because it was torn somewhere or something. So you have $2 merchandise inventory, and then you have a loss from the defective merchandise and a credit the cost of goods sold because you are reversing the cost of goods sold, the expense side, as well as sale. Buyer granted allowances. Assume that $40 of the merchandise is defective, but the buyer says, keep it and I'll give you a $10 price reduction. And you say, okay, all right. So sales returns and allowances are going to be debited because your customer got that consideration from you, and we credit cash for $10. Let's talk about some adjustments and closings for a merchandise company, okay? Oh my goodness, look at this thing here. This would be better presented vertically than horizontally, but take a look at it. Here's the cycle. We have a beginning inventory, and during the month, we buy things, and we take the beginning inventory plus what we bought in terms of the net purchases. That's total purchases minus purchase returns and allowances minus purchase discounts. And you have to add any freight cost in if there's any freight. Add them up. That's the available for sale. At the end of the month, say 1,000 garments, we sold 700 of those garments. Pretend those 700 garments times $100 each, that would go into your income statement. The remaining 300 are still in your ending inventory. Note that your ending inventory becomes the beginning inventory for the next month, and you go through the same thought process. Net purchases are added to the beginning inventory equals the merchandise available for sale. What was sold goes to cost of goods sold. What isn't sold is in the inventory, and you start all over again. Adjusting entries. Shrinkage, huh? Shrinkage. Shrinkage is the term for missing inventory. Okay, we can think of it that way. Here's what we're talking about. You take a physical inventory, say at the end of the month. You go out and you count your inventory, and there should be $1,250 worth of goods in your warehouse. You go out and you count it, and you recount it, and you're very comfortable you got the count right, but you only counted 1,000. You don't know what happened to that $250. Could have been stolen. It could have been damaged. Maybe there's unrecorded transactions or something. All you know is your inventory no longer is $1,250. It's only 1,000. So you're gonna debit an account called cost of goods sold dash shrinkage. Cost of goods sold dash shrinkage. That's what we called it where I worked for many years. And you credit merchandise inventory. So you suffer a loss here. Sales discounts, returns, and allowances. New revenue recognition rules require reporting of sales at net amount expected. Adjusting entries are required for expected sales returns and allowances, expected sales discounts. Oop, I'm sorry. I like how they skipped the closing entries. If to those of you who took accounting 110, you should remember this, right? Closing entries. You close all of the income statement accounts. You close them to retained earnings. If you had sales in this case of 321,000 and expenses of 308, the difference between the two is 12.9. That's your income. That income is going to get rolled over to equity at the end of the month. Closing entries. What you're doing is zeroing out the sales and zeroing out everything else that appears on your income statement. So your sales have a normal credit balance, so you have to debit it. Balance in sales is now zero. And we're putting it into a temporary account called income summary. You'll never see income summary on your financial statements. It's just a temporary account where we're going to run the closing numbers through. So we close the sales, and now we have to credit all of the expenses and contras that are on the income statement. Having done that, add them up, we get 308,100. We debit income summary, the 308,100, and credit all of these expenses. So now we have a profit of $12,900 after we bring the 301,800 into the income summary. The balance in the income summary now is our net income, okay? Then we're going to take that balance in the income summary, that credit balance, hopefully, we're going to debit income summary, credit retained earnings. And then we close the dividends into retained earnings directly. So that's a brief look at closing entries. Define and prepare multiple step, single step income statements, okay? A single step income statement is a very simple presentation. It's your sales. You're just going to see a sales number, sales, and then you're going to see the word expenses, and then a list of all the expenses. Cost of goods sold will be listed as an expense, and heating bill and rent and all that. It's just a simple itemization. More useful, though, to people interested in the company would be what we might call a multiple step income statement, where we're going to have various subtotals for people to ponder, okay? Here we have sales of 321,000 gross sales minus sales discounts and returns and allowances. That gives us something we want to call net sales, 314,700. The cost of goods sold was 230,400, giving us a gross profit of $84,300, okay? This means that we bought garments for $230,400 and sold them for $321,000. So just on the markup, we make a profit of $84,300. Now we're going to break the operating expenses out into selling and admin, okay? Selling and admin, administrative expenses, general and admin. What are selling expenses? Any cost related to advertising the product, selling the product, shipping the product, huh? Those are all selling expenses, okay? You could have depreciation on the company's car. You might have a fleet of salesmen with company cars driving around. All those expenses would be selling expense. Maybe your sales managers have offices they need to be accounted for. So you got total selling expense, general and admin, I call it admin, is pretty much everything else. That's the accounting department, the bosses of the company, maybe the purchasing department, the engineers, human resources. So we add up the G&A expenses, get 29.3, total operating expenses 71.4. When we subtract that from the gross profit, we get $12,900, the number we were just looking at earlier. So you can see this presentation is a lot more useful. The other one, you can't do any real analysis with it without a pencil and paper. Here, you got some things done for you where you can make some judgments, okay? Income from operations. Income from operations is just that. It's the income you generated from doing whatever the company is supposed to do as a core indicator. If you're a Coca-Cola bottling company, your operating profit comes from buying and selling goods in soda cans. You make soda, you sell soda. That's your operating profit. You also can have other revenues and expenses like you see here. Interest revenue, gain on the sale of building, interest expense, and what else they have? And then they total them up. You could have a whole bunch of those there, okay? Those have nothing to do with running the company. Interest expense is because you borrowed money. You're not a bank. So those expenses don't belong in the operating area, okay? So if you're looking at this company and you're looking at, you might start with the net income. Oh, wow, 15 million, that's not bad. 14 point, we'll pretend we're a big company, huh? 14,900,000. But then you notice that 1/7 of that, 2,000 of that is an interest income and the gain, they sold a building. You don't sell buildings all the time. You might do that once every couple of years, maybe. So what investors really want to see is the income from operations. Income there says you're making money the way you intended. Here's a single step. And you can see how simple the difference is. You got your sales and revenues and gains all up here. And cost of goods sold is shown just as another operating expense. And there's our profit of 14,900. This would not be of much help to an investor. They might pick up on the 1,500 in expense, and then they have to pick and choose up here. They'd have to go through it line by line. Let's see, interest revenue, we don't want that. That's 3,500 there, minus the 1,500. You get the idea? Your balance sheet is also going to be multi-step, okay? You are going to start with your assets. You're going to have a line called assets, and then maybe indent, and you're going to write current assets, colon maybe, and you're going to list all of the current assets. A current asset, of course, is an asset which we expect to use, get the benefit of in the next year, okay? An asset that's going to get chewed up in the next year. You must list your current assets in the order of liquidity. Liquidity means the ease of turning an asset into cash. Cash is liquid. Accounts receivable is fairly liquid. You know you're going to get paid by your customers. At least you hope so. You're 99% sure, I guess, huh? That's pretty liquid. Your inventory, well, you got to sell that. It's not quite as liquid. And then you have office supplies, store supplies, stuff they're not too liquid at all. And an insurance policy, the only way you can liquefy that is to sell the policy to somebody else. But those are your current assets. Let's look at the acid test, the acid test, the oatmeal test, the acid test ratio. and explain its use. I believe in the last chapter, we talked a little bit about the current ratio, right? Current ratio, current assets minus current liabilities gives you working capital. Current assets divided by current liabilities gives you a current ratio. And we decided that needed to be above 1 for sure. Acid test. Here, we're taking what are called the quick assets, quick assets, the real liquid stuff, and dividing it by the current liabilities. So the liquid stuff consists of your cash and receivables, and maybe you have some short-term investments. Short-term investments, maybe a 6-month certificate of deposit or a 1-year bond or something. But cash, investments, short-term, and receivables divided by current liabilities is going to give you something called the acid test ratio. And a common rule of thumb, they're saying it should have a value of at least 1. If it's over 1, you can be pretty sure the company is unlikely to have liquidity problems in the near future. It just means that they have this much money left over if they paid off all their bills, short-term bills, current bills. And here they're looking at a couple of companies, Acid test ratio. It's also, it's also called the quick ratio. I was trying to remember the right word. Quick ratio is the same thing as the acid test ratio, okay? So again, cash, investments, receivables divided by the current liabilities. And they're showing you Nike and Under Armour, And Nike had quick assets of 92, 87, 96, current assets, current liabilities. It's tough to compare companies of different sizes. I have a small company. I have $1 million company. And I have $25,000, or I have $25,000 in working capital, say. Assets, current assets minus current liabilities. You have a much bigger company and you have 50,000, but I have a better percentage when I do my acid test and current ratio. So that means I'm doing better than you, even though you're a much bigger player. So let's look at the acid test for Nike. 1.5 a couple of years ago, 1.6, 1.8. They seem to be building that up pretty good, Same thing with the current ratio. That would have to go up as well, I guess. The acid test ratio for Under Armour shows that they were okay 2 years ago, and they were okay 1 year, but here they fell below 1. And what that means is that they don't have the ability, they don't have the ready cash, the ready working capital to pay off all of their current assets right now on the acid test ratio. But they're okay with the current ratio, 2.2. If it was 3.2, it would be even better, right? 4.2. What if it was 25 to 1? Would that be good? Probably not, because that indicates you're hoarding cash, which can be used to make more money. In other words, if you've got a 25 to 1 current ratio, you might be missing out on investments. Maybe you can use that money to build a new factory, hire some employees, etc. Compute the gross margin ratio. Again, gross margin ratio is the gross margin divided by net sales. I don't know why they put it up there in such a confusing manner. It's the gross margin divided by net sales. Net sales minus cost of goods sold gives you gross margin. Gross margin divided by net sales. It's the percentage of dollars available to cover expenses and provide a profit. And this is just on the markup of the product. In other words, in the current year, they don't tell us what company this is, huh? In the current year, this company had a gross margin of 15,315,000. The net sales were 34,350. You divide it out, you get 44.6%. The prior 2 years were 46. So there's a little bit of attrition there, nothing to worry about, I wouldn't think. So gross margin divided by net sales equals a gross margin ratio. And that is an important number for management. Management may have a goal that their gross margin needs to be 50%. Anything below 50% is unacceptable. You do this calculation, you know what it is, and you can attack it. At this point, I'm going to cut the lecture off, okay? I'm deliberately not going into the appendix because I don't think that I'm supposed to. I'm going to double check, though, with my boss. And if it turns out that we do want to go through the appendix, I'm going to put together a good lecture for you guys. We can meet up and go through them all, okay? So that's a quick look at chapter 4. Not too bad. Any questions, anybody? Any comments? Who do you like in the Super Bowl? Nobody has anything to say. You okay, Barry? Are you there, Maria?
Yeah, I'm here.
Okay, no questions?
No questions. Thank you.
Okay, no questions, Brendan?
No, I'm good for now. Thank you, though.
Okay, we'll call it a day. And you know what might have happened Monday? I wonder if I confused this class with my 110 class and did the lecture at 11 o'clock instead of 1 o'clock. Maybe that's how I screwed you guys up. But were you able to look at the lecture, though, once it was posted in Canvas?
I haven't checked.
It's there in Canvas for you. And I think that was the disconnect. I think I mixed up the time of the class. Okay, well, I'll let you all go. Thank you very much for hanging in there with me.
Thank you. Have a good day.
Thank you.
See you Monday at the right time.
Yeah.